Oh, what a year it has been. There's no doubt. Today, we're going to be talking about my expectations for the market in 2021 and what I think we're going to be seeing in the next year. Obviously, pretty interesting because this year in the market has been one of the craziest ones I've seen, undoubtedly. Just starting off with the Robinhood portfolio, obviously, show you up 37% this year is pretty nice. But take into consideration, we'll be looking at all the factors that'll lead into what potentially could mean next year. So up 37% is a massive, massive year, and you shouldn't expect that. For the most part, you can expect historically between 7 and 10% gain per year in the market for the most part. And obviously, this is my portfolio, which has a chance to outperform your personal portfolio, has a chance to outperform the indices. What do the indices do this year? Well, the Dow Jones Industrial Average is up 5.81. The S&P 500 up 14.3. The NASDAQ Composite up 42.74%. And if you look here, you can see you're seeing green pretty well everywhere here, which is pretty incredible to see. It's not necessarily that you get this chance. The only time you see is under the Dow Jones. The utility average is one that's down. And you see overall in the other indices here, the PHLX oil service understandably is down 44% pretty massively. KBW Bank also down, and Illyrian MLP. So again, there's some areas here that are down in terms of percentage. You have to consider that. It's not necessarily a slam dunk for the whole market, but in general, this is a fantastic year so far. And what I think is quite incredible, and you need to consider this when you talk about next year, is how in the world is the market showing these incredible growth rates? I mean, 42% on the NASDAQ, 15 or 14% on the S&P 500, the Dow Jones up 5%. Seems incredible, right? When you consider the fact that we went through and are still currently going through, frankly, recession-type environment, and, well, we've seen massive recovery. You can't deny it. You've seen massive recovery, and we're getting back to normal to an extent. But earlier this year, you need to think about the fact that in Q2 of this year, we saw the GDP shrink 30%, over 30%. That is an absolute recession. It's absolutely a recession. Yet the market is in the green. So we've overcome a recession. Unemployment rates incredibly over 20% within weeks. Yet we're still in the green. Unemployment still sits over 10%. But we've got a green year. And I think that means a lot of things for me. It concerns me for the next year because I do believe at some point we're going to get hit with more realistic expectations of some of these stocks that have kind of been riding high on the premise of people just investing in everything and thinking everything's peachy, but it's not necessarily the case. Some of these sectors are not going to be performing super well in 2021, and I think that's a very important thing you need to consider, is that it's going to be more of a based on sector type environment. Now, as far as any sort of major crashes, I can't say if I necessarily can see that happening. At most, we're not going to see a 40% decline like we did this year in a month's period. But I could see a downward period. I absolutely could. And there's many reasons for it. You need to consider first politically. Well, who will be the next president? Joe Biden, right? So Joe Biden's already committed now. He's committed now to his first 100 days having a complete mask mandate. And on top of that, I only mention that because not necessarily the masks are going to be what's causing any sort of economic issue. The issue coming from that becomes what else is included in that. Does this open up the doorway for states to close down restaurants again, to close down fast or salons, to close down a major portion of their business? So you need to consider that. You need to really, really consider the fact that this opens the door for a lot of different things. And if we see another shutdown, I gotta be honest, I think there will be some selling out in the market. I don't think you can deny that. If investors see another shutdown, there will be panic yet again, and people will sell out of their positions for fear of those companies that aren't going to make it. And there are a lot of companies that have been gone bankrupt from this and still will, so you need to consider that. What do we have on top of that too as far as negative news as well? A new coronavirus variant has been found in the UK, a new strain. They've just today shut down travel entirely as far as plane is concerned. Any travel from the UK has been completely banned. So you need to consider that in the fact that that likely has already spread, depending on, anything. It does depend, obviously. You need to consider that on who is most affected. What exactly is the difference here? Is the vaccine still a valid supplement here? It's hard to say, because I would put the vaccine in a positive light here. You think about, I think, some unsureness when it comes to the vaccine, but there is a vaccine rolling out which will help people return to normalcy. But does this new strain now mean that vaccine will be entirely useless? I think there's potential for it, so you need to consider that. Now, if it does get to a point where the vaccine becomes relatively useless, well, then what happens? We likely see more shutdown. We likely do see more shutdown and economic shrinkage. So you need to consider all the possibilities here. But I do want to look at the positives, because there certainly are ones. What has carried us this year, frankly, has been, well, stimulus spending. Get me out of here. But so we've just released a second round of stimulus checks, finally, it feels like, which is going to include $600 to individuals and approximately $600 more per child, $600 per child, $600 per individual who is an independent, obviously. We shall see how that looks. What you need to consider as well is, well, unemployment benefits is something to consider. So they've lowered it now, obviously, $300 weekly now for 11 weeks from the end of December through March 14th. So $300 weekly isn't a lot now. It's a lot better than when we saw $600 or even $900 per week, where people were getting $800, really more than anyone working, just for not working at all. And that was encouraging people not to work. Let's just be frankly honest. People were encouraged not to work because they knew they could receive a good wage from literally sitting at home watching Netflix or Disney Plus on their couch. And a lot of people took advantage of that. Now, with lowering it to $300, I think that is a benefit, because I think people will still want to work, because $300 isn't quite a lot, but those who need it can utilize that. $300 isn't much, but you can obviously live off $300 weekly if you're smart. But no one's going to choose to do that over trying to get a job. So I like that. But anytime you increase benefits for unemployment, it encourages people to utilize it. And it's unfortunate that people do that, and they do cheat the system in a manner. So you got to consider that. But unemployment needs to continue going down to keep this market as hot as it is. Other positives include, well, e-commerce. You need to look at e-commerce, as U.S. online sales are projected to grow 32% over last year's, supposedly, which I think is 100% viable. If you look at any of these retail companies that have reported earnings, you're seeing massive growth in e-commerce, and this seems pretty viable to me. But you are expected to see a shrinkage, certainly overall in terms of in-store shopping. Shrinkage of, quite significant amounts on the year. Now, overall, quarter for all holiday shopping that takes place online. 25% of online shopping for the holidays is expected to take place online, which is up 20% from a year ago. So e-commerce is a major benefit if we talk about next year potentially. There's a lot of jobs that could be created. Again, if you think about physical retailers, a lot of jobs that could be lost, so you need to consider that. But I think if online has been outweighing the decrease in terms of in-store purchases, which it has, then I don't think there's an issue necessarily there. And I think it helps the economy perform well. So I like that. I do like spending, and I think spending is quite nice. And finally, I want to look at the GDP because you need to think about things here. So I've just pulled it up from 2017. Naturally, bad year for us. Expected to shrink total of 3.7% in terms of GDP. A negative GDP, not good. You don't want to see a negative growth rate, obviously, because that's a decline. But we are expected next year to see a recovery of 3.2%, which is pretty darn good historically. If you look back in the day, historically, 3.2% is pretty solid. It's where we want to be. Typically, we see around 2.5 or less, so it's usually around 1.5 to 2.5 in that range. And to see 3.5 or 3.2 is pretty significant. Now, 2022 is even expected to grow higher. If we shrink down, we can see a little bit better in terms of that. Expected to grow 3.5% in the year following that. So we are expected to see some good growth in terms of GDP to make up for the loss that we've seen. Now, if this is feasible and actually works out this way, I think it'd be pretty exciting, and I think it could mean a lot for us. So you do need to consider all of that. Overall, I do think, and it seems wild to call for a green year. It does. But I do think the resiliency in this market will continue, and I think it will be carried by certain segments. I don't think all sectors are going to be green by any means. Not like this year. This year was wild in that aspect. But I do think overall you're going to see a green market. I can't tell you if it's necessarily going to be which indices because, well, the NASDAQ showing a 42% growth rate is quite absurd. But I do think even following the year after this, 2021 here, you're still going to be seeing massive benefit for these tech companies that make a big portion of the NASDAQ up. So you're still going to be seeing incredible growth, at least for the first half of the year for them. So it's hard to call on that one, but I do think the Dow Jones recovers some in terms of the loss that they saw earlier in this year. I do think they're going to continue to recover. The Dow Jones certainly should be in the green. The S&P 500 I think will be in the green. The NASDAQ it's such an interesting one because you see a 42% gain, and how is that sustainable into the next year? To see another positive growth, it almost seems unlikely. But I could still see it being green because these companies are performing super well and people are spending a lot. GDP growth, we've recovered very well, obviously, from the dip in March. And I still think we're going to see green next year, okay? I think it's crazy, but I'm expecting green, and I'm going to keep investing. It's what I do. I keep investing even in the bad times, and if we see big dips, I invest more. So I'm not concerned with the market in this point. Valuation is not incredibly cheap right now, but I still think that we're not going to see a significant dip, in my opinion. And if we did, it'll be within the first couple months of the year. So I'm pretty positive, pretty bullish on the next few years as a whole, because I think the recovery is going to be pretty nice for us. So, and I think as people return to normalcy, we're going to see a lot more spend and investing done. So that's something I'm pretty excited about. So keep an eye out for that. And really, I do hope you have an excellent day.